Hey everybody, welcome to the daily analysis video of your big major indices and asset classes. It is May 3rd, 5:06 p.m. as we talk. Let's jump right into the spiders. So you can notice here that we closed the day positive on the spiders. After 2 days of rallying, you can see that we found a low here with this beautiful bottoming tail, and we had this massive rip yesterday, flag sideways, flag sideways. And then today when we opened a little bit down, but then it was basically upward bullish pressure ever since. We did have some sell action later in the afternoon, but the markets were saved again. And you can notice here that one of the reasons why the markets have put in this little bit of a topping tail here and basically did not trade above this point of resistance is if we scroll out of the charts, and this is still the intraday charts, and we just draw a simple trend line going from that pivot high all the way there. And I made it on purpose to connect right on the closing basis of this little bit of a reversal topping tail candle there. But notice the resistance. You have this pivot 1, pivot 2, and all of a sudden these pivot tops here. So that's your line in the sand. Basically, I think before the markets will break out above this, we have to find out what happens with the FOMC tomorrow. Are they going to remain extra hawkish, or are they just going to be hawkish? What degree, in terms of dovishness or hawkishness, are they going to throw at the markets? We all know that we're going to get a rate hike. We know that their main mandate that they're fighting right now is inflation, which is pretty much a dire threat, and it's been proving to be a little more persistent versus the transitory that they were originally thinking. So now here at Trading Capital, we firmly believe that inflation is going to last at least 2 years. The fastest way to wipe out inflation and reduce it is through a recession. If we have a recession, which frankly we need one and are due for one, but it's always been reversed because we've printed large amounts of quantitative easing to prop up the market, and the so-called companies that should be going bankrupt, we've kept afloat with free money robbing from the future. But anyways, not going down that rabbit hole. The big eyes are on the Fed tomorrow. I suspect we're going to be trading in a tight range tomorrow. We're going to get some extra volatility. Should the Fed surprise the markets with a 0.75 or 1% Fed fund rate hike, the markets will sell off. If they stick to their original plan of a 0.5% hike and they provide some sort of dovishness or maybe a lesser degree of hawkishness due to the fact that the Q1 GDP is set to contract by minus 1.4%, then the markets can rally. We're in the camp that the markets have a strong chance of rallying just due to the fact that they are oversold, especially some of the bigger cap tech names. Some of them are actually into some great support levels, which favor short-term mounts. But as we head lower and lower in the charts, until we hit those major technical support areas, the bounces are not going to be as robust. So you can clearly see we're trading in this little bit of a wedge pattern. Tomorrow we will have an answer. Are we going to break up on the chart tomorrow, or are we going to break down on the chart tomorrow? So, we'll know this pretty quickly by tomorrow what the outcome is going to be. But essentially, I think the market's waiting for the Federal Reserve. We did have a few companies report decent earnings, like AMD, pretty big market cap. They were up in the after hours. I think Lyft was down. Starbucks was up, even though they missed severely on their Chinese earnings. But I think the markets are favorable for a bounce. If we flip to the daily chart, you can see where we are in terms of the price action. Let me just remove this trend line so we have a clearer picture. Notice how we've been trading in this channel. You can see we have this pivot high here, your original breakout zone before breaking up, another pivot low, another pivot. You came close to hitting the low range of this channel. And then up here you have your two major pivots. This was your high in the charts back in January. And then essentially this was your other high after that robust sell-off happened in early March. And then the rally proceeded into late March. So as you can see, we've completely negated all of those gains that happened there. Had some massive selling pressure. Now, I don't think we're going to bounce as much as we did here. I'm expecting some sort of a bounce, maybe halfway. So potentially, I think your big level of resistance is going to be these pivot tops here. we will be looking to accumulate short positions on the spiders and other specific stocks when we head into that area. Now, should the markets be surprised by some sort of Fed announcement today, your next level of support will be down here at the lower end of the channel. I think that'll be an impeccable area to buy for a potential trade. One of the reasons why is when you actually look at it, you have this technical gap fill, and you also have the gap window, which just so happens to line up with this pivot low here. So in between these two yellow bars, it's going to correlate with the lower end of this channel, this parallel channel. And if for some reason the market dumps out, which this is about 4% away, then expect that to be a significant buying opportunity for the next bounce level. But if the markets remain, if the Federal Reserve remains a little more dovish, and it gives the market a little bit of a relief, then the markets should rally up to this blue line. So right now we're kind of in no man's land. They could go either way. You can see that the risk to reward is about a 50-50, but the markets are still technically oversold. The one thing you have going for the markets is that this bottoming candle here came on a substantial amount of volume, so 158 million shares were traded. So it actually trumps all of this whole sell-off action. So it stands to suggest that this bottom is likely, not a guarantee, but is likely to hold as support. Now everything's going to be pretty much a spider's trade. There's a handful of stocks like Netflix, PayPal that are extremely beaten down, which could rally on their own. Teladoc, you saw that today as well. But the SPY did finish up just under half a percentage point. The QQQ was a little bit flat on the day, just finished positive 0.11%, so nothing to really sneeze at there. But let me just remove all of these drawings, my day trading lines. I'm going to turn off these moving averages so we can get a proper picture. The Nasdaq is showing a little more relative weakness in comparison. You can see that we've made a significant low on the chart. The same thing, the Nasdaq had decent volume on this bottoming candle, so it stands to suggest that you can potentially rally. If you were to, mount some sort of rally, this is the level that I'm looking for. These previous pivot tops, these pivot lows, this pivot low area, this chop here, this chop consolidation before breaking lower. The 340 mark is where I potentially see a max rally in the Nasdaq. And then you also have this other term, this trend line over here, that'll act as resistance in the event that you get through this yellow trend line. But that'll be a huge area for the markets to get through. If for some reason the Nasdaq and big cap tech can sustain some sort of a bounce, I'm going to be personally looking to start accumulating short positions on the Nasdaq right around this 340 level. If you get through that, you have a key technical gap there. That'll be an amazing level to again add to those short positions on the Nasdaq. Let's take a look at gold. Gold has clearly been under a severe amount of pressure. As you can tell, we had this channel, this bear flag pattern that was playing out, broke to the downside. And the thing about these rising upsloping parallel channels is when they're rising upsloping, they're more likely to break down. Just like a rising wedge, a lot of people confuse rising wedge with bull flags or bull flag pennant formations, but a rising wedge is often one of the most overlooked bearish patterns. A lot of people have this misconception that a rising wedge is bullish because it's trending upwards, but rising wedge, more times than not, if you had to look at 100 charts or 1,000,000 charts, basically between 70 to 80% of the rising wedges break lower. So again, we had this rising parallel channel and it broke lower, it hasn't officially completed the max downside move in this bear flag formation, but you have some buyers stepping in here around the 1850 level. I'm still looking for one flush lower. I really want to see gold get down just below the 200, in between this area here and this area here. We basically have two levels around this 1840 level and then basically this 1818 level. If for some reason you get anything lower than that, anything sub 17 will be an amazing buy opportunity. But I do think you do get that final flush in gold. Just the fact that Gold today, you can see it had this massive pop, bottoming tail, and then it faded off of the highs. And look what was resistance. Your previous support zone, which is this multi-decade arc formation. Since you broke it, you did not confirm below, but since you broke it, you broke key support. Key support now becomes resistance. As you can see, you bounced up, hit resistance, and pulled back off of that resistance. Now, you didn't confirm the breakdown in this gold pattern, but in the event that you do break lower down to these levels, you do have a failed, you do have pretty much a completed breakdown in effect. And this arc pattern is playing out exactly like the 2004 cycle if we take you on a weekly basis, where I pointed out in my previous videos, and it just so happens to be lining up just, you know, with impeccable, you know, qualities of similarity. So if you see here, this was a multi-year decade arc formation, just like the one we have in effect now. You have your double top formation with a weekly chart, exactly like the current pattern that we're going through now. Gold broke down, you broke this arc, came back up to test this arc. The arc was resistance because you broke down, and then look, you had the sell off lower. So I'm in the camp that you still go lower on gold. That's why I'm being patient, waiting for our next flush down, and we'll just have to see, because this M top, double top, topping weekly topping tail pattern, breaking the arc, gold is playing exactly the way it did in this 2004 cycle. So it's just very interesting to watch those correlations with the metals. We've been pretty spot on with our metals trades this year so far. We still are ultra bullish for gold over the next, say, 6 to 12 months, but just over the next you know, several weeks, we're somewhat bearish, and we see a little bit more downside on gold. Silver, amazing chart. Things like this just really get me excited. Basically, if you look at all these red candles, we have 11 daily red candles in a row on silver. That is exceptionally rare, And you've pierced this retrace of the breakout zone, and it does look like you're going to test your triple bottom, which again, in previous videos, we were calling for. Now, we did start accumulating silver, the SLV I'll flip to. We're slightly out of the money. Our average is 21.06. We have a small position. We're prepared to add at these key technical levels here around this 1987 level. If it goes lower, we'll also add at this 1858 level, which just so happens to be a major technical gap on the chart. Could it flush down there? It absolutely could, but silver should be primed to have a big move to the upside. It did have a key breakout, but now you're starting to trade below all the moving averages again. If we flip to a weekly basis, you can still see that this is a massive bull flag formation on a longer time frame. On a weekly basis, you're still trading above the 200-day moving average. If you were to flush down to this weekly 200-day moving average, it just so happens to coincide with the gap fill on the SLV around this 1858 level. So stay tuned for that. We are looking to pick up GLD in and around this gap fill here, this 168 level, or this 169, 170. Basically, I'm going to draw a big X. I have many trend lines here which may be confusing, but anywhere in and around this zone here, this zone here, we're looking to buy GLD. So basically 170 all the way to like 168-ish, we will be buyers of the GLD for a nice swing trade. One of the things that support are putting tremendous pressure on the metals, and you may not see the metals uptick until the US dollar falls. So if we go to the US UUP, we are shorting the UUP. We're slightly out of the money, but if we flip to the weekly basis, the UUP has had this exceptional run. Actually, I'm just going to show the DXY. It's a little more accurate. Let me just wait for my keyboard to wake up. Okay, so DXY. And that's not the right one. Sorry, let me just go to the DXY. The Dixie, there we go. So one of the reasons we're shorting the US dollar is look at this double top scenario. Until you start seeing the US dollar pull back, that's, I think, when gold starts to get its lift. So they have a high correlation rate. When the US dollar is rising, typically gold is falling. That's exactly what we're seeing to date. Now, they can rally simultaneously. We did see that When the war initially broke out, people were flocking to dollars as well as gold. But now that the war has kind of settled down, I think that since the US dollar is remaining strong relative to other fiat currencies, that's why there's a tremendous pressure on the metals. So once we see the US dollar fall, and I think it will fall, I think there's a substantial correction lying all the way back to these pivot tops here around the 99.38 level. I think until you start seeing the US dollar fall, that's when gold's going to get its next leg to the upside. If you look at the US 10-year, let's just touch on rates quickly. The US 10-year tagged, it actually pierced the 3% mark, which is that beautiful whole number. It is into 3-year resistance. And at the same time, if you look on a weekly basis, the interest rates are on a 1, 2, 3, 4, 5 weeks of upside in a row, with one consolidation week here and then another 3. So you had 8 out of the 9 last weekly green candles were all positive candles. So now that you're hit this 3% mark, I think it's a short-term pullback down to this downsloping trend line. This downsloping trend line is your long-term trend line going back all the way to the 70s. So I think it's more than a 50-year trend line, and I think you will retrace to. Notice how this was your original breakout bar, your impulse move through that long-term resistance. And the beautiful thing is that we saw this coming. You had this, you pierced it, had this pullback, this tight consolidation off of that resistance. You consolidated just under, and then you had this massive rip-roaring rally to the upside in rates. Do I think interest rates are done rallying yet? In the short term, I do. Bonds are oversold, rates are overextended. I think rates have to pull back slightly, sort of to the 2.5 area, something like this, and then before they start making their next leg up to probably around 5%. Max move I have is around 6 or 7 at the highs, but 5% would put tremendous pressure on basically all of the over-leveraged asset classes, real estate, you name it. All of it will be under tremendous, tremendous pressure should the US 10-year and the Federal Reserve stick to their long-term forecast of raising rates and fighting inflation. I hope that's a great video. I hope everyone is ready for Fed Day tomorrow. Should be some pretty choppy price action. We are positioned to benefit from some oversold long swing trades. So, you know, the likes of Netflix, the likes of Amazon. But we do have some shorts out there in some overextended names that I believe do have a strong chance of continuing to fall, even if the markets rally. So stay tuned for price action. Hope everybody has a wonderful evening.